So we've been through trend, we looked at candlestick patterns, we looked at chart patterns, we looked at support and resistance lines. I cannot impress upon you how important support and resistance lines are going to be for your trades. If you do nothing else, you have to make sure that your support and resistance lines, you practice, you review, you do it properly. Crucial to your trades. I can trade with nothing else, but my support and resistance lines have to be there. It gives me the boundaries of when to hold a trade, when to get off a trade. If you have attended my daily currency call, you will note that support and resistance lines are a lot key to what I do on my analysis. The next part is indicators. Indicators is one section where I have put in a lot of time and effort into not only understanding, refining, and also creating indicators that I use up to today, and I've shared with you in the files there. So I hope you go through this section, you understand that indicators are there not to tell you whether to buy or to sell. Indicators are really there to guide you through whether to buy or to sell, to help you with your analysis whether to buy or to sell. In the overall process of the 5 steps, looking at news, trend, support, resistance, and then indicators, you'll notice that indicators is the last thing that I look at, because by the time I have looked at news, trend, and support resistance, I can more or less develop the idea of whether I'm looking to buy or looking to sell. Indicators, or what we call price action, really just gives me a better timing of getting into a trade or not. With that said, indicators or price action are mathematical calculations of previous price movements. We can't calculate future price movements because we don't know what the future is going to be, but it calculates the previous price movements. These calculations are interpreted and highlight the sentiment of the current market, because everyone's going to see what happens from price previously and form their bias of what could happen into the future. As much as historical data does not project the future, people do get a sentiment or feel of what could happen and project it and plan their trades and project it into the market. So with that, it gives us a slight insight into potential or possible future targets. As I said at the start, you should not be using indicators to tell you whether to buy or to sell. You should be using indicators to tell you when it is a good time after you have decided to buy or to sell, or not to do anything. Remember, not doing anything is also a good option sometimes. Indicators are very useful to provide market and price movement information, which if you're new, you might miss just by looking at the chart. Indicators are generally considered slow because it requires price to complete moving before it can calculate. So it is a little bit lagging. Sometimes with big price movements, we could have outlier events. And then you see that the indicator does not take it into consideration, or it takes it into consideration and throws the indicator totally out of whack. So with that, you want to use indicators. That's also the reason why I put indicators as one of the last things I look at, because I've already formed my judgment leading up to this indicator. A lot of times, there are going to be conversations of whether price action, having a clean chart with no indicators, is better than having indicators to tell you. And they're going to say that indicators are lagging, so you should have a clean chart with nothing and just understanding how price moves. There will be something that you can work towards, having a clean chart. But right now, how I would like you to view indicators is to view it as something that helps you translate price action. If you look at price action right now, you will not be able to understand it too well because you're still learning what it means, you're still learning what it tells you. Indicators, I would suggest you use it as a translation of what price tells you. So you translate it to tell you whether it's a good time to buy or whether it's a time to wait, whether if you've decided to sell, it's a good time to sell. There are endless amounts of indicators that you can deploy in your trading strategies. Endless. You can go through the list over and over again. You can fill up your charts full of indicators and you might be super confused. So these are my top 4 indicators that I use up to today. You see that my charts, when I share my charts and my views, my trade ideas, these indicators are in there. These 4 are the Bollinger Band, the Moving Average Convergence and Divergence, MACD, the Stochastics, and the Parabolic Stop and Reversal, PSAR. These 4. I'll be guiding you through these 4, and only these 4. I hope you have installed it as well. So Bollinger Bands. What are Bollinger Bands? Bollinger Bands is a volatility indicator. A volatility indicator. It actually tells you how high or how low price can move during any period. If the market is volatile, the bands will widen. And when the market is less volatile or is quiet, the bands will contract. It will be narrow. To give you an example of how Bollinger Bands look, you will see the green line, the red line, red line, red line, and the green line. These are Bollinger Bands. And you also notice the red arrow and the blue arrow there in the candles. I'll tell you more about that. Those are the additional indicators that I've added to Bollinger Bands to help you identify one of the users of Bollinger Bands. So with Bollinger Bands, what I've actually done, the normal Bollinger Bands come only in the 2 standard deviation, which is the green lines. I'll flick back only on the green lines. Those are the 2 standard deviation Bollinger Bands. What I've actually done and provided you with is also the 1 standard deviation Bollinger Band, which is the red lines. With the 2 and the 1 standard deviation Bollinger Bands, you will be able to identify and use it in 3 different ways. The Bollinger Squeeze, the outside of Bollinger Band, and the Bollinger Trend. Right? 3 ways: Bollinger Squeeze, outside of Bollinger, and the Bollinger Trend. First one, Bollinger Squeeze. Here, Bollinger Squeeze is identified when the bands contract for a period of time and when it's leading up to a pending news event or news data to be released. This indicates the potential for a big upcoming, big move. Okay, you see that the Bollinger Band squeeze, Bollinger Squeeze actually looks like the rectangle pattern that I was sharing with you just then. Remember, this is important. Remember, take note of this. The Bollinger Squeeze should only be used in the H1 and H4 time frame. You can use it in a higher time frame, but it is very unlikely to occur. And even if it does occur, it's going to take a very long time because you're going to need to squeeze for a long period of time on the daily time frame. That's going to take several days or even weeks. So it's not worth and very unlikely to see a Bollinger Squeeze over weeks. What usually happens is you will see it squeeze over days, such as situations like this week where we're looking at a lead up into the non-farm payrolls. Or on the H4 time frame where it could be leading up to an FOMC news release. Those are big news events and you can plan for it maybe a week or 2 weeks in advance. It's a very zoomed in view, but you will see that Bollinger has actually squeezed. It's usually white. This has actually squeezed down and looks like it's moving across in those areas I've circled out for you. And you can also note that at these points, what follows from that squeeze is a big move. It doesn't always have to be a big move downwards or a big move upwards. It could always be dependent, it's always dependent on the news. But what prerequisites is the squeeze. You see it move across with bands tightening, being narrow. One thing I would like for you to do is to start identifying Bollinger Squeeze and start posting them as you identify them so that we can make sure that you're doing the right thing. So that's Bollinger Squeeze. The next way we use Bollinger Bands is when it's outside of Bollinger. Okay, what happens when the big move, when price has a big jump and it's outside of the 2 standard deviation of Bollinger Band? If you understand math, which you don't have to, but if you look at the math in it, if it's outside of 2 standard deviation, it is very likely that price will stop moving in that direction and return back within the Bollinger Band. Most likely is that price will stop moving in that direction and return back into Bollinger Band. But there are also scenarios where price could remain outside of Bollinger Band and not move back. It'll just continue going down or continue moving up. For the outside of Bollinger Band usage, you can apply this across all time frames on your chart. I'll give you an example of how this looks. You see in the first circle here on the left, the candle has moved outside of Bollinger Band, broke outside of Bollinger Band, closed outside of that green line, and then the subsequent ones, it moves back in. You see 2 white candles moving back in because it's closed outside of the 2 standard deviation and it's moved back in. At this point, you also want to take note of the red arrow. The red arrow that you have there, it will pop up live. When price goes outside of Bollinger Band, you will see a red arrow appear. It actually tells you not to sell. It tells you that it is outside of Bollinger Band, not to sell. Wait. It actually tells you that it's outside of Bollinger Band. You'll see on the next circle, on the next oval on the right, the big candle, big black candle downwards. The next one is outside of Bollinger Band, red arrow appears. It tells you it's outside Bollinger Band, red arrow appears. The next candle comes back into Bollinger Band or onto Bollinger Band. And then after that, it drops lower again. Again, the red arrow appears. Again, it ends up outside of the Bollinger Band. And then you see it come back into Bollinger Band again. So this is actually a very powerful tool that I really do hope you deploy into your trading. I'll tell you more about it. You can see an example here. First one on the left, outside of Bollinger Band. 2 candles outside. Next one goes straight back in. Very quickly, you see it goes all the way up, goes outside of Bollinger Band on upwards, and comes straight back in again. You see a blue arrow there. The blue arrow tells you it is outside of Bollinger Band. Be careful, look out, don't do anything. And then it comes back in. And then on the right side here, you see, even if it's slightly outside of Bollinger Band, red arrow comes out, tells you to be careful. Next move is back into Bollinger Band. Third example I have here is where it stays outside of Bollinger Band and it doesn't come back in for a couple of candles. At this point, you see that although the blue arrow did appear very early in the move, that's slightly outside of Bollinger Band, the next 1, 2, 3, 4, 5, 6 candles remained outside of Bollinger Band before it came back in. These situations are probably driven by big news that has caused the market to move significantly, and that's why price has led the indicator, has gone ahead of in the indicator. So this is the reason, another explanation why we have not seen price come back into Bollinger Band and stayed outside of Bollinger Band. So what happens when you see price outside of the Bollinger Band? You should either not enter a trade. It actually tells you that it is too late to get into a trade. If it's outside, you've seen it drop outside of Bollinger Band, the red arrow appears. At that point, it should be telling you you're too late to enter a trade. If you do enter a trade, it's more likely to bounce back up. So it tells you not to enter a trade so that you avoid a loss of capital. Or if you see it outside of Bollinger Band and you do have a trade running, you might be making money. And then you see the blue arrow appear that's outside of Bollinger Band on the upside. Maybe it's time to get out of your trade. Close your trade to prevent a possible loss of profits. So how you should be using this outside of Bollinger Band tool is to prevent you from entering a trade too late. Prevent you from entering a trade too late. Usually you see that because you try to enter because of emotion. So it prevents you from trading with too much emotions, enter a trade too late, or it will get you out of a trade at almost the best possible point to get out of a trade without being too greedy. Because a lot of times when you see a market shoot up, you think it's going to keep going higher. You're making money, you think you're going to keep making a lot more. And then the next moment, it retraces back down. So this actually tells you to get out of a trade, secure your profits. So this outside of Bollinger Band tool is really there to make sure you avoid a loss of capital and prevent losses of profits. Very, very, very powerful tool here for your trading. The third way to use Bollinger Band is when you see price stuck within the 1 and 2 standard deviation. What I say within the 1 and 2 standard deviation is where it's inside. This is 1 standard deviation on the downwards, 2 standard deviation on the downwards. You see it inside that 1 and 2 standard deviation. This is when price is likely to trend in that direction, either downwards or upwards. And you can use this Bollinger trend on H1, H4, and D1 time frame. You see some examples here of the Bollinger trend as it moves up. So just then I'll show you the downward move. This is the upward move of the Bollinger trend within the 2 standard and the 1 standard deviation. And then on the right side, again, even if it's outside of the 2 standard deviation, the blue arrow comes out, it comes back in, stays within the 1 and 2 standard deviation, you can continue trading it upwards. So I hope the first of our indicators, the Bollinger Band, has made sense to you. I hope you have questions. If you have questions, put it in the comments. The guys will answer your questions. There are 3 ways to use Bollinger Bands: Bollinger Squeeze, the outside of Bollinger, and the Bollinger Trend. What I ask you now is what do you think is my favorite of the 3 Bollingers? Squeeze, outside, or trend? Put that in the comments. We'll take again a quick break as you formulate your ideas. And if you have any questions, ask them before we move into the MACD, the moving average, convergence, divergence.